Hello, everyone. Thank you so much for joining us. We will wait for like 10 seconds to make sure everyone is connected and technically ready to start our event. So just wait a second, and we have some people who are joining from the waiting room still. Good. Thank you so much once again. My real pleasure to welcome you to our regular valuation and portfolio management workshop 2024. We have prepared a series of presentations on a variety of topics regarding the valuation and portfolio management. I'm sure it will be quite interesting and exciting event for today, and the real platform for you to exchange your knowledge, your expertise, your thought within the areas of the interest of our speakers and yourself as well, for sure. I know that we have the air alarm for Kiev and several other regions of Ukraine. So I will start with the security reasons. In case of the air alarms and the security issues and everything, you are welcome to disconnect, and we will give you and distribute the recordings from the event. In case of any other disruptions, just because of the security issues, we will let you know and we will instruct you separately. We are starting today with this series and the sessions with the speakers. We will have the 4 sessions. The preliminary agenda for today, we will have like 30, 40, 45 minutes presentations of each of the speakers, and then the time for Q&A session. All the timing you could get from your mailings, your registration things, and so on. If you have any questions, you are free to contact us as the hosts here in the chat. Please use this opportunity to be as more interactive as possible and use the chat, or just to use the raise a hand tool here, and we will make sure you are unmuted and could address your question openly with a microphone or a video if you want. I think that's all from my side. I would like to start with our first guest. We will devote our first topic to the public equity markets, specifically to the macro-based investment approach. I'm happy to introduce you Andriy Hryshchuk, Investment Associate of Blackshield Capital. So please, Andriy, this virtual stage is yours.
Yes, thanks. So hello, everyone. Yes, my name is Andriy, and I'm working in Blackshield Capital for more than 5 years. So yes, I am more responsible for specifically public equity markets, especially US and European market, help a portfolio manager for to develop and to manage our investment strategies, mainly conservative investment strategies. And one of the greatest examples of our, for example, one of the investment strategies which we implement is our macro-based investment strategy. So, and we will share our views, share our experience with you today. And I hope that it finds you really interesting, because it's rather new topic for, I think so, for our local market, because unfortunately we don't have such like a big and developed financial market in Ukraine, especially when we talk about equities, of course. So, of course, we will start, and not only start, but show you all our analysis based on foreign financial markets, yes, and especially US market. So yes, let's start. So today's content is quite easy. So we will start just with our with overview of main investment approaches, and finish with more practical side, yes, which is more about navigating the business cycle and how to extrapolate on financial markets, and how to use all this type of information for your investment strategy on public equity markets. So let's start with an overview of main investment approaches on public equity markets. So today I would highlight like only like four main investment approaches, which is widely used, not only like in our company, but also when we talk about foreign colleagues. So the first one is quite easy, and it's quite it's quite easy just to understand. It's like stock picking strategy. Yes, when we identify stocks with like improving fundamentals, and we just believe that this stock will rise in share price because of its rising fundamentals, rising cash flows, and rising net income or rising dividends, etc. So it's more about like stock picking strategy. Let's name it like this. The second one is thematic investing. So here we talk about some baskets. Yes, here we talk about some beliefs, our own beliefs, that we believe in electric vehicles, in cybersecurity, or some artificial intelligence equity baskets, and some stocks which are linked to these thematics. So we will name it as a thematic investing. Yes. The third one is price momentum. It's more about it is a mix of some technical and some fundamental analysis. Yes, and it's more appropriate not for long term, but for more short term or mid term, like in terms of when we talk about that our maximum investment horizon is 1 year. Yes, so it's more appropriate for like short or mid term investments, and it is a mix of, as I said, some technical analysis and some fundamental analysis. So when we talk about technical analysis, we're talking about some moving averages, SMAs, etc. When we talk about fundamentals, we're talking about EPS revisions by analysts, sales revision, cash flow revisions, etc. So, and the last one, which is which I will try just to explain for you and just to share our views on it, is macro-based approach. So this approach is more for it is directly linked to macroeconomics, of course, macroeconomy of your country or in which you are trying to invest. Yes, and this macro-based approach is based like more on approach of how to identify stocks that may benefit from changes in some macroeconomic conditions. So here we talk about, for example, some changes in unemployment rates or some changes in inflation, GDP, etc. So this approach is mainly based on changes in macroeconomic inputs. And like, to be honest, and I would share my own views, that this approach is one of the has one of the greatest number of risk-adjusted return historically. Yes, and this number is quite in terms of risk adjusting. In terms of risk adjusting, is quite better in comparison with others. And of course, here we talk about more conservative strategies when we talk about macro-based approach. So yes, here we start just with passive investing and with active investing. So of course, every investor can just invest like in some financial instruments like ETFs. Yes, for example, when we talk about S&P 500, so we can just buy SPX. Yes, and as a usual typical investor, even in Ukraine or in local other foreign markets, we know that on average, public equity markets can make a return on average on 10–12% per year. Yes, but as we can see on the right graph, of course, there are a lot of like drops, and we can see that the dynamics of the index, yes, and the financial market as a whole during different phases is quite like volatile. Yes, and it indicating that we can manage our risks. Yes, when we just invest in, for example, ETF, and we can try like to, for example, to mix some sectors, to mix some equities, and to make our strategy with lower risks. So here we need to highlight that just passive investing, of course, it's quite easy, but of course, we need here also to talk about a lot of risks which are associated mainly with different macroeconomic environments, which directly influences financial markets. So here is a slide. It's more about what drives equity price movements, yes. And I would share not only like our view, but also a view of such a big company or such a big bank as UBS, yes. And they have made their own research, yes, which was more about impact on S&P 500 index price return, yes. And they took, for example, more than 30 years till 2008. They made their own quantitative models, and they observed that mainly, like more than 15 years ago, EPS impact and price to earnings multiples impact on price returns was equal. But now we see that price to earnings impact, or just multiples impact, it has a higher value. And that's why we can make a conclusion that such higher contribution leads us to one conclusion, that macroeconomic conditions have a greater influence on have a greater influence on price returns, because only macroeconomic conditions like can lead to some changes, dramatical changes in level of your own multiples, yes. And fundamentals, from year to year, we see that fundamental side, when we talk about EPS impact, for example, yes, when we took price to earnings multiple as a like oftenly used multiple, we can see that EPS impact is going lower and lower. And that's why it highlights that this approach, which is based on macroeconomic conditions, is getting quite popular, because, as I said, and as I wanted to highlight, that the higher level of multiples value in your price return is getting higher from year to year, from period, from cycle to cycle. So that's highlight our today's topic and why it is important to use and to analyze macroeconomic conditions in your investment strategies. Also, here's another example. This is a model which is made by Bloomberg. It is like more quantitative approach on how to analyze what drives the market. And here we also talk about US market and S&P 500 index. So we see the decomposition, yes, of S&P 500 index dynamics, and we see that from like 2005, macroeconomic factors, they influence for more than 60 or 70% of all price return of S&P 500 index, yes. But we also need to highlight there that there are some times when we can see that the weight of a factor can fluctuate, yes. And for example, we can see it that starting from like 2 years ago, or 3 years ago, we can see that risk sentiment factor has started to increase, and that's why we can see that the influence of some macroeconomic factors can be lower from time to time. But mainly when we took long-term horizon, we can make a conclusion that such factors as economic demand, economic supply, and monetary policy factors, they drive more than 70% of total public equity performance. And that's why it also highlights why it is important to take into account macroeconomic conditions when you invest in public equity, in such category of asset classes, public equity. But yes, now let's speak more about, we have already highlighted why it is important, and now it is important to go further and to understand what is like a business cycle, and why it is important to understand it. Yes, why it is important to understand where we are. So, as we have already seen, macroeconomic conditions, they greatly affect asset pricing, yes. But it's not, I would say that it's quite easy to say only this thing. Of course, we need to go deeper and to drill out this topic. and to understand that we need to at least understand in which phase of business cycle we are, yes, at least for now. And then this it can be a good base for us for our investment strategy, because different business cycle phases, they leads to different investment approaches, to different asset, especially when we talk about equities, to even specific types of equities which we wanted to invest and which we decide to invest. Yes, so here we need to understand that the most widely recognized method on how to characterize business cycle into phases, like GAP model. So it takes into account growth, inflation, and central bank policy. Yes, so this is three main pillars which can fully characterize our business cycle phase. Yes, and as we can also know from like academic texts, business cycle on average takes like 10 or 12 years, yes. But we need to understand that from time to time, we need to navigate this business cycle to navigate where we are. And that's why change our investment approach this time, because in different, as I said previously, in different business cycle phase, we have different asset class performances. And even when we talk about equities, when we talk about different sectors or different companies, they have also some differences in their performance in accordance to certain business cycle phase. So, but we will talk about it later. But here is just a good example on how to understand business cycle phase and on why it is important. So yes, and here is a slide which like more practical, can be more practical, yes. So it's just a good example of one of the best indicators which can be used when we talk about public equity markets. It is PMI or Purchasing Managers Index. It is this is an index which can tell us what is going on about our real sector of economy. When we talk about ISM manufacturing PMI, such indicators, of course, we can also take into account other indicators like services PMI, which will tell us about service sector of economy. But here we stop on ISM manufacturing PMI because it has long history, and that's why it is more appropriate to use it, because we can see that we have a quite good and high correlation between these two variables. So the first variable is ISM manufacturing PMI, yes, which is Purchasing Manager Index, and one of the mostly used aggregated macroeconomic indicators, and S&P 500 index dynamics from year to year. Yes, and we see that some dramatical drops or dramatical risings or some turning points which we can highlight on the right scale when we talk about left on graph on the left side. Yes, when we talk about ISM manufacturing PMI, it has a really good strength with the S&P 500 dynamics. So it also highlights that macroeconomics leads financial markets to some vector, for example, when we talk about growth or some dramatical drops, etc. So, and also it is not only a good representative of financial markets, for financial markets, yes, it is also a good representative of current economic conditions, yes, because it has its own, I would say, forecasting power for example, such indicators as GDP, yes, and we can see, like on the right graph, is that such indicators, they have a leading power, mostly, which can fluctuate, of course, but on average, it is between from 8 to 12 months. So we need to navigate these indicators, and they will tell us at least where the economy is going. Changes in the economy, and as a conclusion, what can be what can be happened on financial markets. Now I would just only stop on this indicator as an example, because it is one of the indicators which you can use freely. Yes, because it is like free and you don't need to make your own quantitative models, which is based on a number of macroeconomic indicators. Yes, so I would just like wanted to highlight why such indicators has its own power to predict future economic conditions and has a higher correlation with financial markets. So we have already stated that of course, there is a good correlation between changes in macroeconomic conditions and stock markets. Yes, but we need to understand that if we wanted to predict our future probable, I would highlight this word, probable future performance of some asset classes, we need to understand why, how economy. How current economic conditions can be changed, yes, in what direction. So, and such indicators as ISM manufacturing PMI has an answer, yes, because it has own forecasting power, as I said, for one of the reasons is that because it is Purchasing Managers Index, which is a survey that measures the early stages of the supply chain, yes. So it directly measures what is going on inside the companies from materials sector or from manufacturing sector, yes, and that's why it can be a good early indicator of what is going on in the economy and what we can expect further. Yes, for example, for company earnings from distribution sector, from retail sector, and what can be going on with the consumption. So that's why such indicators, they have its own leading power, and that's why we can make some suggestions based on it. Yes, and just to try to forecast or try to consider what can be going on in the future when we talk about financial markets. Here I wanted just to highlight like other examples of such indicators, yes, which can help us to navigate the business cycle, yes, and how to define current economic cycle phases. So first of all, like we can also divide all these alternative and auxiliary methods into 4 groups. So the first group, we have already talked about it. So it is global, regional, and local PMIs. Yes. So there's a number of like local, regional PMIs from S&P agency, for example, or from ISM agency. So we can use both, or we can just try to dive into methodology and to decide which is the best one. So it is also one of the good examples when we do not want to make our own quantitative driven model, for example. The next group is aggregated leading economic indicators. So here we can like name one of the greatest example is Conference Board leading economic indicator. So it is of course used, and is not only used, and it is calculated for US market, but it is also has a good forecasting power, and it also has some like stable correlation with financial markets. So that's why some drops and growth in such indicators can also lead to some financial markets growth or drops. Some auxiliary indicators, yes, because we need to understand that such aggregated leading indicators or some surveys as PMIs, they are aggregated indicators in itself, but we need to understand that like such aggregated indicators, for example, cannot fulfill all our needs, and sometimes like economy can, for example, we can be in a recession just because of some drops in, like, I don't know, in liquidity, in market liquidity, yes, for example, and that's why we need to try to also to navigate it, yes. And some early signs of, for example, of market liquidity, of some drops in market liquidity can also be, for example, highlighted when we use Goldman Sachs Financial Conditions Index, yes, for example, because it is a good measure of what is going on when we talk about monetary policy, and when we talk about financial conditions in the economy and liquidity itself. Also, a great example is a spread between 3 months and 10-year yield on US Treasuries. It's one of the greatest, I would say, early indicators of US recession. More than 90% of all the recessions they were predicted by this indicator, for example. So that's why some auxiliary indicators can really help us also to determine some things which cannot be determined by some aggregated indicators. So that's why we need to use it, just because we need to be more stable with our current investment position, yes, and with our current investment approach. And the last one is quantitative-driven models. So it is quite hard, like, to explain what is it about, just because it is more about some, of course, quantitative approaches, and like, also it is of course it is made by, for example, our company. We have made our own quantitative driven model, which can tell us about more your state of US economy and the European economy. So such quantitative driven models, they good because they are better in comparison with all other aggregated indicators, just not because it's made by itself and we have our own assumptions we can include our own assumptions, yes. It's just because we can use wide group of macroeconomic like coincident and also leading indicators, yes. And we can also try to nowcast business cycle, for example, or to forecast business cycle, yes, because all these three previous groups, they are more about nowcasting. They are not more about forecasting. They're more about like forecasting GDP growth or what can be going on with inflation. But they don't have such strengths when we talk about like financial markets and forecasting financial markets and forecasting financial movements. So that's why some quantitative driven models, they have a good strength and they have a good correlation when we talk about like forecasting especially financial market movements and what can be going on further. So that's why it solves this problem, yes, with nowcasting financial markets performance. And that's why it is really better to I would say it is, of course, better to have your own quantitative model and just do not rely on some other indicators. But it really solves the problem when we talk about like not only just forecasting on 100% that financial market will be growing up or going down. It just tells us about some probabilities. It just tells us about some technical things. It just tells us about some momentum signs, yes, about liquidity, or for example, what is going on when we talk about put-call ratios, what is going on when we talk about some quotations of on derivatives markets, yes, because it has a big influence on financial markets performance. So this is a good, like, just I would say so snapshot of some like group of indicators, yes, which can really help us to navigate business cycle, to forecast some economic perspectives, yes, and also can help us to navigate what is going on and why the market is growing or why the market is going down. So that's why they're really important. And I wanted to highlight it another yeah, I just wanted to highlight it. Yeah. So yes, and this is more like practical side. Yes, we have already discussed. That like why it is important to navigate business cycles, why it is important to include in your analysis, in your investment strategies, macroeconomic approach, why it is important to forecast future economy shifts. Yes, because it directly influences financial markets performance. But now it is more practical side, and this side is more about this side of question, because here we talk about our like public equity market positioning. Yes, so I would be honest that at least we can divide our public equity market positioning into two groups. So first of all, when we talk about sectors of the economy. So, and the second one, it's more about some risk factor groups. So here we talk about some, for example, I don't know, companies with a high exposure to some emerging markets, or companies with higher return on equity, or companies with lower leverage. So we can divide in two groups, but the second one is quite harder, like just to explain it 5 minutes. So we will stop just on the first one. So, and this group, it is more about like equity positioning when we talk about sectors. So as we have already said, we have business cycles, yes, and of course these changes in business cycle phases, they influences different sectors from different sides. Yes, first of all, and secondly, it has its own consequences on each sector. Yes, so that's why we need to understand that as we have different consequences on each sector, yes, different influence on each sector, we need to understand that different sector will act differently, yes, as a conclusion. So that's why when we have already navigated like current business cycle phase, for example, yes, and we are, I don't know, in a slowdown phase of our economic cycle, from historical perspectives, and just not only from historical and quantitative side, but also with some qualitative arguments, we can say that, for example, such sectors as healthcare or consumer staples or industrials can have a greater performance in comparison with other sectors. So that's why, accordingly to this macroeconomic approach, it is more appropriate to invest to companies from this sector. Of course, we need also to understand in which companies, yes, but it's just a matter of like fundamental analysis, yes, which companies are the best in this sector, and that's why we need to invest in these companies. But like when we talk about macro approach and top-down approach, and we stop just only when we talk about sectors, we have our own, of course, as I said, quantitative and qualitative arguments why these sectors, they perform in different business cycle phases differently. Yes, and as I said, for example, healthcare is a good is a good way to invest also when the economy is in slowdown phase, just because healthcare, it's more about they have a better state when we talk about that inflation is growing up, but GDP is going down. Yes, and they can lead, they cannot lead, but they can make their own, for example, pricing organization. I'm sorry, I will just try to formulate these thesis shortly. But like healthcare, it's, when we talk about like healthcare, it is like a defensive sector which has a good elasticity when we talk about like prices, yes, price changes and consumption changes. And that's why such sectors, in such circumstances, when the GDP is going down, we need to understand that the demand for healthcare services and for example, pharmaceutical drugs probably would not be going down, just because we need to understand that like healthcare services and pharmaceutical products, they're essential for our lives. Yes, so here we talk about like such economical terms as elasticity of product, etc. So that's why we can also qualitatively argument why healthcare can perform better in a slowdown phase. The same is for consumer staples. Yes, for example, such company as a Coca-Cola or Procter & Gamble, it is like a they sell more commodity products. Yes, not like a product like an auto company from consumer discretionary sector. Yes, this sector is not more cyclically sensitive, and that's why it also has the same arguments as we have talked about healthcare earlier. So as a conclusion, we can say that some macroeconomic changes, they lead to changes in, and they have a big influence on financial markets performance. Yes, and we have proved it. Secondly, we have a lot of we have a big number of some aggregated indicators which can help us to navigate macroeconomic conditions and which can help us to navigate business cycle. And as a conclusion, it can also help us to navigate which equities we want to buy when we talk about equities. Also, it works for bond market. Also, it works sometimes, but with other assumptions, of course, and with other inputs when we talk about commodities. So as you can see, it has a direct influence and it has direct consequences on performance when we talk about S&P 500 index, but when we do not take into account just the whole index, but when we try to divide the performance of this index in some sectors. So that's why I want to just to stop here, I think, and I would be happy to answer on your questions. So yeah, thanks for your attention, and I am open for your questions.
Thank you so much, Andriy. I will remind our participants, you have two options. You could raise a hand and we could unmute you and make sure you could address your questions by yourself, or just use the chat. We have several questions in the chat, so I will start with in the order of the chat. So we have the question from Nadia, probably in 2 words. Could you please explain why exists the inverse relation between interest rates and the bond prices?
Yeah, thanks for your question. So first of all, we need to understand that some changes in interest rates, they directly influences future coupon rates on some corporate bonds, for example, yes, or government bonds, of course. And when investors understand that in the nearest future, central bank will lower rates, and of course rise rates, yes. Of course, they understand that it is more interesting to buy future securities with higher coupon rates. So that's why they decide to sell current bonds, for example, government or even corporate bonds, yes, to sell current bonds, and that's why they are trying to invest and they want to invest in the future bonds with a higher coupon rates. So that's why it has an inverse relationship. Yes, when the interest rates in the economy are rising, that's why we have some drops in bond prices. But of course, we have by itself, we have a rise in yields to maturity. So that's the main reason why we can observe such inverse relationships.
Thank you so much, Andriy. I have second question from Roman. When considering individual passive investor with 10 plus years investing horizon, how valuable is to constantly check various indicators and test their predictive power, or does it make more sense to do that for investors in particular sectors or specific stocks who are more active and try to outsmart the market?
Yeah, thanks also for this question. So it is quite interesting. I would answer from this side. First of all, when we talk about 10 years plus years, 10 years plus investment horizon. So first of all, we also need to understand what is going on with risk profile of your fund, for example, or of your client. Yes. So first of all, we need just to understand that, like, some clients can be really not so risk averse, but they have also like higher investing horizon. Yes, long investment horizon. So that's why we also need to understand that some strategies can be implemented according to their risk profile, and some strategies cannot be implemented. Yes. And when we talk about when you are saying that, like, individual passive investors with 10 years plus investing horizon. So in such case, I would, just in my opinion, I would say so that it is more better to analyze and to check these indicators, at least for like from time to time, just to increase your risk-adjusted return. First of all, yes. First of all, secondly, just to check what is going on now when we talk about like some points, some current quotations, because some current quotations can be quite high, and that's why even 10 years plus investment horizon cannot help you just to like manage all the volatility which can be observed in the future. For example, look at the Japan market, previous all-time high was in 1989, yes, and only now, from more than 30 years, yes, some investors which, for example, have invested in Nikkei index, they have some returns and it took 30 years. So that's why it is crucial, even in such investment, in such cases, it is also crucial to check all these indicators and to try to understand why current quotations they can be high and why current quotations they can be quite low on financial markets. So that's why I think so that it is in this case it is also important to understand and also to navigate the business cycle, and also try to like understand what is going on with like in the future. When we talk about that, we have already invested and then we are trying to navigate and we're trying to analyze. So I think that, of course, this should be as a constant process of analyzing.
Thank you so much. Thank you for your questions, and thank you for answer. Probably in this topic of active and passive investing, because you have started with this, we had the recent research from the CFA Institute, and they mentioned that passive investing is one of the key mega trends of the market and the industry at all, because of the like very different conditions that it's like the force for this growing passive investing. In this case, and the growing interest to the AI and this implementation into the industry, what is your expectations on the future of active investing at all?
So as for me, of course, I understand like why passive investing, like my opinion on passive investing, it has all, of course, benefits, yes, because we have historical observations, yes, when we talk about US market or European market, yes, because these studies, they are more based on like US market and European market, yes, and of course they have a good representative side when we talk about like passive investing in terms of like average 1 year, average 5 year, average 10 year risk-adjusted return. So, and they are quite can be quite interesting for an investor. Yes, but also I just wanted to highlight another example, Japan. Japan is a good example why passive investing can be really not so good in some cases. Yes. So look at the like Nikkei index dynamics, and we will just understand why it is crucial to be also an active investor on public equity market. So that's why I can make a conclusion that in the future, of course, like passive investing will be quite popular among retail investors totally, I think so. But when we talk about like some high net worth clients and some corporate clients, of course, passive investing, it's not more that they want. Yes, they want some more like active investment strategies. So that's why I think so, and I believe so, that an active investing approaches, they will be also quite popular. And as I said, just see Nikkei index dynamics performance, and we will find the answer why it is important.
Thank you so much. We have another question in our chat. Hello, when you are valuing a company, what would be the preferred valuation method, especially in private markets or less liquid markets? Multiple based or DCF? Could you please share your thoughts on this? Which one would you say is more practical and brings better results? Thank you.
Yeah, also thanks for your attention. Thanks for your question. So I'm sorry, 1 second. So when we talk about private markets, I am not an expert in private equity. I'm not an expert in private markets. So I would talk about only like public equity, public side, yes, in public equities. So when we talk about public equities, first of all, it is also hard just to have a definite answer. Multiple-based approach or DCF or DDM or other approaches, economic valuated models, they are better. Like when we talk about financial markets, public equity market as a whole, yes. So we can only like just to divide stocks or equities into some groups when it is more appropriate to use multiples or DCF or other cash flow approach or other discounted methods on how to value your target company. Yes, for example, like in our reality, we need to understand that some like quite unprofitable companies even on operating side, yes, when they have negative EBIT, for example, yes. So it is of course more important, like from public equity side, to use multiples approach, yes, because we have day-to-day quotations and markets, they are in the constant process of aggregating all the information which is going on about this company, and that's why it is more appropriate like to use multiples, yes, because we cannot say that just one company can be, yeah, of course there can be some outliers when we talk about sectors, their peers, etc. But for example, for some unprofitable companies, it is more appropriate to use like in some cases like EV to sales multiples, for example, yes. But when we talk about some companies which has more stable and they're mature, also like we can use, for example, different multiples like PE or EBITDA because they're profitable, or price to free cash flow, or DCF approach, because in this case it is more appropriate and we have a stable base for our future forecast. Yes, so that's why we can use different multiples here, and we can use not only relative approach, but we can use also DCF approach, for example. So I cannot have a definite answer when we talk about like liquid markets, yes, and which method is the best one. I would just categorize into some groups, yes, and just according to these groups, just like from my side, I will use particular multiples, particular approaches, just because this company is profitable or not profitable. They have some problems with cash flow, or they don't have some problems with cash flows, etc. So it's just based on too many facts. So there is no certain answer.
Thank you so much. Good. We will probably wait for 10-20 seconds for the questions. We will have any in the chat or with the raised hands. Okay. Good, thank you so much. I will probably give 5 minutes rest before the next session because we have the intensive day today. I would like to thank Andriy for the great presentation and the insights on the topic. I think it was quite interesting, and I'm sure useful, my apologies, useful for our audience. Thank you so much for those who had questions and addressed it on the chat. We will see each other in 5 minutes for our next presentations. Thank you so much, Andriy.
Yeah,
Yeah,
I'm so sorry. I'm so sorry for interruption. I just want to to make some ads. Yes, about because we have made our own investment reports like for free. Yes, so we try like also just to share it with our clients, not only with our clients but with public audience. So you can buy by using our QR codes, mainly like which directly can which is directly linked to our website. So here you can see our weekly insights reports, which is a short reports about state of the US, European, Chinese economy, financial markets, and also you can read our Telegram channel, where we also share our own thoughts on what is going on. We share our own thoughts what is going on about some changes in macroeconomic indicators and macroeconomy as a whole. So we will be happy to see you there, to see you as a reader. So join us. It is quite interesting, and I would also share with you one thing that we are preparing our like quarter overview, and you can subscribe to our to our newsletter. Yes, and you will also be a reader of our quarter overview for the diversified, like I would say, for the all instruments on financial markets, as US equities, bonds, European equities, Chinese equities, commodities, etc. So we will be happy to see you as a reader. So join us. Thanks.
Thanks, Andriy. And I believe if we could share the presentation, or at least this slide with all the QR codes to make sure everyone have enough time to scan, that would be great. Okay.
Yep.
I think this is the great finish of our first session. So we'll see each other like in 5 minutes for our next session with Yevhen and Sova. So please just stay with us. Thank you.
Today we will talk about M&A transactions. Any content shared does not represent any view of any of the firms. I am showing it for informational purposes, so please do not use it as a professional advice. That's a brief disclaimer. And now I will share my screen. Just a moment. Yeah, I hope you can see it.
Yes.
Thanks. So I understand that many of us who is participating today have different backgrounds. Some of you may be a very seasoned, experienced valuation experts. Some of you may be very young but curious and raising stars. There may be some who are from academy or from other industrial fields. That's why I try to make it quite simple but still informative. We will begin from some fundamental questions, but they are quite important to understand before we move on. So, the fundamental and key question is, why do we need to value the value? There are some instances where it may be needed. It may be for making investment decisions, whether to hold, sell, or buy a stock. It may be for exit strategy planning if you are a private equity firm. You may use it as a corporation when you make your strategic planning decisions, when launching new products, entering new markets, or when maybe evaluating some different investment projects. You may use it in M&A deals when you need to define the purchase price in the transaction. Banks use it for estimating the capital of the company, for establishing some covenants, etc. There may be some employee stock ownership plans, which are also linked to the value of the company. Of course, financial and tax reporting, where we need to establish a fair value. Legal disputes, etc. You may need it for your CFA research challenge to evaluate the company, to establish to calculate its value. But we have a hint here. Why do we need it in today's session? Today we will talk about more how to, why we will talk about one of the most natural instances where the M&A valuation is needed. It's in the deals. And the determining price there is quite an interesting issue as for me. And why do we need those M&A deals? There may be some possible rationales for the buyer. For example, if the buyer wants to increase its market share, buying other companies. There may be a reason for vertical integration when the company wants to buy its supplier, or when we want to acquire some innovative entities, startups, to transform our own business. By the way, it may be one of the trends in the AI era, where the very old, very established corporations may just purchase cutting-edge technology companies. If we are talking about the IT sector, you may acquire talent and some IP rights and tangible assets through those transactions. And many, many other instances which you can imagine. But today we will talk about more about the pricing mechanisms. Before we start, let's define the key terms. The first term, which is interesting for us, is the enterprise value. It is often called a headline price. The enterprise value shows and measures the total value of the firm's operating assets, the cash flow they will generate in the future. We need to note here that this value is calculated without considering any cash or debt which company may have. And here is an equity value. Equity value is usually the value the investors usually pay for. And if we want to get the equity value, we usually take the enterprise value, we remove debt, we add cash, and we arrive into equity value. So when we know these terms, let's discuss what are key valuation techniques. The first of them is market comparables method. It's one of the most typical methods which are used in M&A transactions. Usually, companies take enterprise value to EBITDA multiple. Sometimes they take enterprise value to revenue multiple or other possible, there may be very specific multiples. And usually this method is backed up by DCF method. A buyer and the seller will themselves build some flow models, and then they will arrive at their value of the enterprise. And after that, they will probably negotiate some market comparable, market multiple, which will be applied to the company's EBITDA. And sometimes these methods may be used in combination just to support each other. Let's talk firstly about this, one of the most common methods, EBITDA multiple method. Here we can see so-called valuation bridge, where we have enterprise value in the beginning, and then we make some adjustments before arriving at equity value. But how do we arrive at this enterprise value? We have some reported EBITDA of the company, or calculated EBITDA before adjustments. After that, the advisor or analyst will calculate some adjustments, we will talk about them later, and arrive at adjusted EBITDA. After that, this metric is multiplied by some valuation multiple. It can be 5, it can be 3, 10, some comparable based on industry analysis or trend analysis. And after that, we arrive at enterprise value. Let me again note that enterprise value is often called headline price because it's the starting value. And the equity value is usually a purchase price. The second method is DCF approach. We will also start from the last 12 months reported EBITDA. We will also make some adjustments and arrive at adjusted EBITDA. This adjusted metric will be used as a basis to evaluate the projected results and growth assumptions. So an analyst will probably apply the adjustments to historical periods to observe what were actual margins historically, what were normal growth rates in revenue, in expenses, and will support the underlying assumptions for the future. In addition, the analyst or appraiser will probably apply these adjustments to the forecast periods, because the aim is to obtain a sustainable normal level of EBITDA and of growth levels. And after this analysis, we can use a DCF model, which can be very simply shown in this formula. We will take the cash flows for forecast period, for terminal period, and discount it back, and arrive at enterprise value. So the approach is quite similar to this, but there are some very specific points. And now let's dive into these adjustments, as I promised. Here we have 3 typical metrics which we have in when defining the price adjustments. First of them is EBITDA. What is our aim when we want to establish a normal level of EBITDA? We want to eliminate any distortions which were in the historical period. We want to present the maintainable earnings trends and provide this proper base for valuation, because it influences the price. And let's again see why it is important. If we go to this slide, you can see here is a multiple. Let's imagine that there was a non-operating income of the company, which was included to EBITDA. And this income comprised about 1,000 units. Let's imagine that the buyer does not exclude this income. After that, this additional excess money of 1,000, let's say, dollars, they're multiplied by 5, by 10, or any other multiple. And these have a direct impact into the equity price. So you will overpay if it is five times higher this excess amount which was not adjusted. That is why we should pay attention to these adjustments. And what are those adjustments actually? There is no single correct approach, but there are some very general principles which are usually applied. First of them is non-recurring and one-off adjustments. Imagine that you are the company that produces milk and dairy products, and in 1 year you sold some cars which you do not need. And this will definitely impact your EBITDA. If you are at the buyer side, you will probably exclude this income because claiming that it is non-operating and one-off, and you will be right. There are some other types of adjustments, such as out-of-period corrections. Imagine that there were some expenses which should be allocated to December 2023, but you allocated them by error in January. In this case, we will need to adjust both January and December figures. There may be some classification issues. Let's imagine, so what is EBITDA actually? EBITDA is some kind of proxy for operating cash flow, for operating income, which you receive normally. And it does not include any finance, income, or expense. Neither it includes D&A. So if the EBITDA includes some kind of interest income or expenses, we would need to reclassify them from this metric to other income expenses. And there may be some pro forma adjustments. They are made in order to reflect the key changes in the business structure for forecasting purposes and for reflecting the company's performance on a run rate to make it comparable between the periods. So imagine we have the company had some pricing scheme with one of the suppliers, and the company paid a fixed price for, let's say, hosting services. And then we understand that in the last period, the pricing scheme has changed, and there will be a new pricing policy in the future. And in this case, we will need to do what? We will need to show this pro forma adjustment as we should need to apply the new pricing, the impact of new pricing scheme to the older periods just for comparison reasons. This adjustment is discussable, may be discussed, but usually it can be showed in this category. And what else? That was EBITDA, a very important kind of adjustments. As I have said, they have a very large impact on our price. The second type we have is net debt or net cash. Let's define it first. Net debt is cash, is debt plus, again, net debt is financial borrowings, other debt-like items less cash. It can include some loans from banks, some borrowings from other parties, but it may also include some debt-like items. For example, your long-term obligations to, it may be to recultivate the soil, it may be to make some guarantee payments, or maybe some commitments or contingencies. It's any long-term or debt-like liability which may be included here. And here is also cash. And we need to analyze whether the cash is whether this amount of cash includes only liquid amounts. Because there may be some instances where some accounts at banks may be frozen or temporarily unavailable, or maybe there are some problems with the bank. That's why we need also to thoroughly analyze this metric. And by the way, this metric is called like dollar for dollar. So any dollar included into the net debt or cash influences have an $1 impact on the equity value, our purchase price. And the third type of considerations is net working capital metric. So what is net working capital? Let's think about it. Net working capital is usually funds that you invest into operating activities of your company. It includes inventory, trade receivables, other receivables, trade payables, some operating other payables. And it does not include cash, because cash is included here into the net debt. So in the net working capital, you may think that of it like some funds that need to be invested in the operating activities. For example, accounts receivable, it's the funds that you are expecting from your customers. You will probably need to invest some funds into the inventory. Yeah, but of course, there are some businesses where it may be even negative, but let's not talk about it now. We just need to understand that there should be there should be enough investment into the net working capital. Because if the seller didn't invest enough funds, then the buyer will need to do it when he or she acquires the company. That's why there should be some, the net working capital at the date of a transaction, it should be, or at any other reference date, should be not in deficit. If there is, it should be not below the normal, so-called normal level. If it is below, there may be a NVC deficit adjustment. The normal level, it can be calculated based on historical numbers. It's not an easy task, it's not a trivial task, but still this adjustment is quite normal in this calculation. And here I put two words in the yellow box and put an exclamation mark. Why did I do that? Because, as you have already guessed, all these adjustments, they need a very detailed, at the same time, and detailed and helicopter view. You need some analytical procedures to know what is a fair value, what is a fair amount of this adjustment. That's where due diligence procedures come at place. So if the buyer conducts a due diligence, they will employ some consultants or some advisors or analysts which will calculate all of this. The seller can also employ some analysts. But this process is very important because each mistake will cost money if there is some mistake or misrepresentation. Let us point our attention to some points, to some key thoughts. First, there is no standard like in audit on the single methodology on calculating these items, these metrics. There are some basic principles which we have already discussed, but there is no right way. It is a matter of commercial, of analytical procedures, etc. And let us think about it that there is a seller and here is a buyer. Each of these parties has their own purposes, their own view over the company and its financials. That is why they will probably make their own procedures before they arrive at the agreed purchase price formula. And in each case, this purchase price formula, let's imagine it is a simple purchase price formula, and it should be tailored to each transaction, to each deal, to its specifics, industry specifics, some individual specifics, etc. And it's an outcome of commercial negotiations. There are usually two typical approaches which are applied in order to calculate this purchase price. So let's dive into these approaches, but before we start, the difference is in at which accounting, at which reporting date we calculate this purchase price, and at which date the economic risk and reward is transferred from the seller to the buyer. So the first of the mechanisms is locked box mechanism. Let's pay our attention to this timeline. Here we can see 3 key dates, or 2 or 3, it depends. So the first one is locked box date. It is sometimes called reference date. There is also a completion date, when the transaction is officially closed. And there is SPA, sales and purchase agreement between the two parties, the date when it is signed. And if we are talking why it is locked box, because the buyer and the seller take financial statements at the locked box date, at some historical date, not at the completion, but at some historical date, and calculate the value of the transaction based on this date. And they lock the box. They focus on some historical financial statement. And this financial statement is usually a reliable one. For example, annual audited financial statements. It is based on the most recent, like written here. And there is a problem for the buyer. Which problem? So the buyer pays at this date, at the locked box date, based on these accounts. But the buyer will gain access and gain economic ownership over their company only at the completion date. And this period is the period where the buyer is at risk. What is the risk actually? The problem is that the seller may try to extract some value from the company. Let's imagine the seller may pay excess dividends not agreed with the buyer. The seller may have some transactions, operations with its friendly or related companies, and also to overpay them. There may be also some other schemes how to extract value from the company. That's why the buyer needs to protect their position. And the buyer will usually put some restrictions on leakages. These extractions are called leakages. That's why the buyer will seek protection to these leakages between the locked box date and the completion date, and specify in this SPA agreement which operations are allowed and which are not. So if it is payment of salary, it's okay. If it is some normal agreed dividends, it's also allowable, but there may be a list of operations which are not allowed. And then if the buyer identifies any of non-permitted leakages, the buyer will seek the adjustment to the completion price, to the price. So the two parties calculated and agreed that the price should be, let's imagine, $735,000 at this locked box date. If the leakage is for $100, which was not included here, then the buyer will deduct it from the price and pay only $635 in thousands. Okay, so let's also pay attention to some other points. Between the locked box date and SPA signing date, there is a period. It can be several weeks, it can run for several months even. And during this period, the buyer will make a due diligence on these locked box accounts. And after the due diligence, the buyer will obtain these net debt estimation, net working capital estimation, and calculate the deficit or excess NWC. And here are two items, which we have not discussed yet. These are permitted leakages and value accrual. So let's start from the value accrual. Because there is a period between the signing and completion and lockbox date where the legal owner of the company is still the seller. And the seller operates the company for this period. And the company will probably generate some profits and some cash. But the seller is not compensated for it because the seller is gaining only this amount based on these accounts. To overcome this inconsistency, there may be some estimation of forecast cash profits between the lockbox date and the completion date, and included here, just to compensate seller for this managing services and to this period between the two dates. There may be some other methods to estimate this value accrual, but we will not focus on them now if there are no questions. And there is another item called permitted leakage. That's the leakage which already incorporated into the price, such as agreed amount of dividends, maybe some salaries, some not salaries, agreed amount of dividends, or some agreed leakages. And they are already in the price, so no additional adjustment is needed. Let's pay our attention to the second type of pricing mechanisms. It's called completion accounts. I guess you may that these type of methods it calculates the price at the completion date. The final price, as written here, is calculated at the date of completion. So there is no such a gap between the two dates. The first date is, as in the lockbox mechanism, it's the reference date, or it was called lockbox date, but here it is some reference historical date when the audited accounts are available. At this date, the two parties will make some preliminary estimation of the price, just to check the formula, to agree the approach to the calculation. There will be enterprise value, metrics, which we have already discussed at this completion date, and other adjustments. And after that, when the formula is agreed and included into the SPA, the parties, the seller or the buyer, they prepare financial statements at the completion date. And it is those statements at the completion dates which are included into the final estimation of the price. The risk is transferred to the buyer, not on the economic risk, yes, transfers to the buyer, not on the lockbox date as here, but on the completion date. So the buyer pays for the actual financial position of the company after signing and after seeing the completion accounts. That's why these adjustments for value accrual, for leakages, is not needed here. And there is no, but here is another part. It is called true-up payment. As you can imagine, the preparation of completion accounts may take some time. So if it is let's say, the 28th of March, the company will need some days, maybe weeks, to prepare these completion statements. But the first tranche, the first amount, is paid at the completion date based on some estimation of completion accounts. And the remaining part is the difference between the actual completion account and estimation is paid at a later date, for example, in several weeks or several months when it is agreed. So We will compare and contrast these two algorithms very soon on the next slides, but for now, let's just pay attention that here in the locked box mechanism, we used reliable accounts which were audited. That were usually annual accounts. And there is a higher probability that they do not contain errors or misrepresentations as compared to this completion account. Why? Because completion accounts are usually not audited. That's why these accounts should be reviewed by the independent auditor. There should be a very clear accounting policies and practices and approaches specified in the sales purchase agreement. It's very important that the sales purchase agreement is very specific, and it says, for example, that some expenses can be capitalized, some cannot be capitalized, that such profits should be included or not included. So it's very important, especially in the case of completion accounts, to specify as specific, to be as detailed as possible when signing SPA. And usually in this process, parties may employ some independent analysts to make this fair, objective estimation of the purchase price. And now we will make some comparison. So what is the difference, pros and cons of each method? So the locked box mechanism, marked as LB, it's usually regarded as seller-friendly because we will find out why in a moment. While the completion accounts, CA, is more buyer-friendly because the buyer will pay for what he or she sees. So the first aspect is complexity of execution. Usually, completion accounts process is more complex. Why? Because you can see here, this process can take some time. The company will need to prepare several sets of accounts. They will need to agree on these completion accounts. So it will take some time, resources, especially resources of the seller's management. That's why sellers do not like it so much. I'm saying just in general, yeah, because each case is very specific. And locked box account is more straightforward. You just take your historical statements and make some additional adjustments. The second point is value leakage. That's why buyers are not so comfortable with locked box mechanisms usually, because there is a disconnect in the value between the locked box and completion dates. The buyer pays the amount estimated at historical date, but receives the company with the value at the completion date. That's why the buyer will need to specify all the possible ways for leakages. The buyer needs to indemnify themselves for any leakages and protect against any problems, any value extractions. And if the financial metrics are very volatile between these two dates, then the locked box mechanism may not be appropriate. Purchase price accuracy. This one stems from the points which we have already discussed. Completion account usually provides a more accurate estimation at completion and less risk for the buyer. But here is another point which is very important for the seller: the purchase price certainty. In case of the locked box mechanism, the seller and the buyer, they already know the price which will be paid. Subject to leakages, of course, but they know the amount which will be paid at closing. It's quite predictable and quite known. And the seller expects this and can forecast his position at the closing. Of course, if there are no leakages. And no post-completion adjustment is needed as in case of completion accounts. But yeah, and in case of that's why in case of locked box accounts, there may be less probability of disputes between the parties, because in case of purchase price adjustment based on completion accounts, the parties may just be may have some disputes, some disagreements on the exact methodology which should be applied. So which one is better? That's a very, very difficult question. There are some points which we should consider before arriving at the conclusion. First of all, it depends on the market where the companies from which the companies come from. In some geographies, the locked box mechanism is more traditional and preferable. In some economies, the completion account is a market typical mechanism. There are also some peculiarities related to the industries. There are also some specifics related to the position, to the negotiating position of the buyer and the seller. If the seller is at stronger position, if there are a dozen or some bidders, the seller can just claim that they prefer locked box. Or there may be the buyer may be at stronger position. And in this case, the buyer may prefer to run it through completion accounts. And there are some other very important considerations which we need to focus on. First, is there any volatility in the metrics, especially in the net working capital and the financial performance of the company? Is the information robust at all? Can we just trust this information? Has there been any due diligence conducted at the locked box date? And whether the forecasting is at all possible, to forecast the performance between the locked box and completion accounts dates. So these points, they just are hinting that if there are some problems with data, with forecasting, robustness of the data, or there is a lack of transparency, a locked box mechanism, which is simpler, should not be applied here. And in this case, the parties will probably apply completion accounts mechanism or some hybrid mechanism. Will management exit the business post-closing? Are there any significant operations with friendly companies between the target company, which is to be sold, and the friendly or related companies? So if the management leaves, if the seller leaves the company immediately after the completion date, there is a high risk that some of the accounts may be manipulated, or the company may not sustain this kind of projected performance in the future. And that may be a problem for using locked box mechanism. Another point is operations with related parties. If there are a significant portion of operations conducted with your not arm's length parties, then there may be a risk of leakages in case of locked box. That's why here we would also prefer completion accounts. And what is the involvement of private equity firms? It is thought that private equity firms prefer some simpler and quicker mechanisms like locked box. So let us sum up key points which we would focus on, which I would like you to focus on. The first point is that there is no single standard general formula for establishing a purchase price. There are some principles, some considerations, some normal practices which are applied in the market. We have already discussed these principles, but every transaction is very specific. Every transaction require deep understanding, deep analysis, and from different points of view. And before paying something, before arriving at the purchase price, it's highly important to estimate what are the relevant risks to this deal. What are some peculiarities of this business model? Only then we can estimate the price and make it as fair as possible. But in any case, the price is a function, is a product of negotiations between the seller and the buyer. So the party which is better informed and thoroughly prepared is at better position to negotiate, to arrive at the price which is more comfortable to this party, and to be sure that this party is not put at risk of overpaying or being underpaid. So in this case, given high risks and given high risk of uncertainty which is observed currently, a good preparation, a good analysis through the due diligence, and careful structure of the SPA is a very sound investment. It's not a cost, it should be thought of as an investment. And I see that we have some time, so let me just mention some other interesting points to finalize this speech. Before that, we talked about some prices which are fixed in the agreement, which are not linked to the company's future performance. These mechanisms, they were based on some historical performance of the company, historical numbers or current numbers, and our assumptions about the future. But there may be some risks that after the buyer obtains the ownership over the company, there may be a risk that the company may underperform. For example, if the management leaves, or if the seller was very involved into the business activities and then leaves after the transactions. In this case, we need some additional mechanism to align the interests of the buyer and the seller. So for this purpose, here is earn-out mechanism. It's additional variable payment which is made in the future if the seller meets several certain targets. These targets are usually some metrics like revenue growth percentage, operating income margin, operating income growth, some level of EBITDA, etc. There may be a bunch of different metrics. And if the seller, if the management or the previous owner of the company meets these targets, then the buyer may make additional payment in the future. It will be calculated based on specific formula. And in this case, in the case of earn-outs, these formula are very, very specific. If here we can see that there is some normal, some basic principles. In case of earn-outs, the formulas may be very specific, but usually from the experience, earn-outs are usually focused on the 3 to 5 years perspective or after the completion date. And another word which is also important is indemnity, indemnity is the protection of the buyer. It's the right of the buyer to obtain some compensation if there is some material and negative event occurs in the future. For example, if the seller was not very keen, was not very good at tax risk management, and some tax risks or some statutory risk crystallize in the future, the buyer may seek protection and seek compensation from the seller. There may be very, very different amounts of leakages, amounts of such events and indemnities incorporated. But in short, to summarize, the pricing mechanism is I would say it's a product of some analytical approach, and it's a product of negotiations. So we should stay informed, and this will strengthen our negotiating position. So thanks for your attention. I would be very glad if you have some questions, or if somebody has some experience or have some comments, you can also add something.
Thank you so much again. We will waiting for those who want to enter the discussion as well. We have the first question in the chat. What general scheme would you suggest to obtain PPE value from EV, which was calculated using DCF, for example?
Some fixed assets, they are already included into the enterprise value. So here we are adjusting the price for such for cash, for net debt, for net working capital deficit. But all those questions related to PPE, they should be factored in on the level of enterprise value. So it's a question of your DCF model or any other model, if I understood it.
Thank you so much. Let's probably wait for several questions more. If any questions, please use the chat or raise a hand. On your opinion, Yevhen, what is because you mentioned several factors and they are quite difficult to estimate. What is the most difficult to estimate during the due diligence during the M&A?
Mm-hmm.
Because
So
here
the short
you
answer,
have a lot,
mm-hmm.
Yes, you have a lot, but what is for your experience, what is the most difficult part in it?
Thanks for your question, Anna. And usually the two words, it depends, are very specific here, but of course, some items have more problems than the others. If we are talking about the definition of net debt, it's also not so, it's also some discussionable because some debt-like items, they may be treated differently by the parties. But one of the most non-trivial items is establishing a normal level of net working capital before we arrive at the net working capital deficit. Because what is the normal level? It can be, we need a very reliable source and very detailed source of our accounts to arrive at the normal level. We should obtain some monthly balances of net working capital. Some firms may have some stable working capital, historical monthly working capital, and in this case, it would be easier. We can just take the average. Some companies are very seasonal. So in this case, just taking the average, it may be the case, but sometimes it would be wiser to factor in this seasonality when you define the normal working capital at a particular date. So here, if the date is here, we will probably base our estimation on these averages. But again, it's a matter of discussion and analysis. There may be very difficult cases where the company is young and growing, or when the company is expanding, and you can see these graphs like this, and here it's much more challenging to establish, but finally it's possible. Yeah.
Yeah, we have the comment.
Have additional questions?
Comment, yes, on the chat. What if the working capital is hugely seasonal, for example, for agricultural companies?
Yes, thanks. I think I have already started to answer this question simultaneously when the question was posted, but there is no single correct answer. Each party may have different opinion, but the advisor will probably analyze. The first question is whether the net working capital data is reliable. So can we make any adjustments at the end of each monthly period? Is it possible at all? If yes, is it only seasonality, or is it also some growing trends or declining trends? Can we factor out those other factors that distort our capital? But just a basic, very I think sensible approach would be to look at this graph, and maybe if your transaction, if you want to establish to calculate the price at this point of time, probably you should look at this cycle, yes, at the cycles at this level, and compare them and take the average. If you're at this point of transaction, you should look at the similar cycle numbers. Okay.
Thank you so much. Okay, we have the question from Igor. How war would affect the valuation mechanics? Would locked box or completion accounts be preferable for the SPA?
Very complex and good questions here. There are a lot of impacts of the war on the transactions. First of all, some transactions were put on hold, some transactions were just renewed, but the overall point is that the time for execution is maybe longer than before, and the transparency and the reliability and the level of risk and uncertainty is much, much higher. That's why there may be problems in the timing, and if there are problems in the timing and quality of information, probably completion accounts would be a good choice if it is possible to negotiate it with the seller. What else? There may be some. I think I have generally answered this question, but there are some another subtopics which are interesting due to the war. There are some expenses which were not typical before, which are typical now. For example, charity expenses. So if we have seen charity expenses before the war, we would probably become very suspicious. What's that? By the way, can you hear me?
Yes, yes, sure.
Internet problems now. Okay.
Yes.
So if we have thought some charity expenses, we would become very suspicious before the war. What is that? Why is it charity? Maybe it's money channeling or something like that. But now many companies they donate for the charity in the normal course of the business, and it's a question whether we need to adjust it or not. Yes, the seller may just want to adjust these expenses, but the buyer will think that this is a new normal now. That's why relocation costs, is it adjustment or not? It's also a question which should be analyzed thoroughly in each transaction. So if the timeline for the execution is longer, if there is some problems with accounts preparation or low reliability, we would probably look for the completion accounts. It would be longer, but it will be more comfortable for the seller, because there may be some adverse events, unfortunately, where the assets may be damaged or just lose their value. And in such a case, the seller will be very, very suspicious and less comfortable with the locked box. Thanks.
Thank you. We have a question from Vladislav. How to factor in some legal disputes in adjusted EBITDA? Can we use probability adjusted legal fines?
Thanks. So legal disputes, some probable costs due to litigations, they are usually factored into the net debt or cash. For example, if we have some probability-weighted estimation of the negative outcome in the court, you will probably make this estimation at the date of calculation and put it as a debt-like item. The same is with CapEx. Yeah. So if we see that the company did not invest enough money into the CapEx, the company would probably seek protection and make additional adjustment for underspent CapEx, or make this adjustment within net debt. The same is for legal disputes, because if you are not a legal company, probably expenses related to legal costs are not your normal course of business, I suppose. And if it's normal course, we cannot include it into the EBITDA. We should include it into the net debt. Thanks.
Thank you. And the question from Sergey, would you account for long-term right of use liabilities like lend-lease contracts in calculating net debt?
So I'm very pleased that a lot of questions today are very specific. I think that people are very experts or they have some questions in their work. Lease liabilities. So as we know, there is a standard IFRS 16, and if the company applies the standard, the company reflects any cost related to the lease as D&A and as interest expense. In this case, it will not be showed as a EBITDA, but the lease liability will be included to the net debt as a debt-like item for consideration. But there may be some instances where the investors want to show a cash expense on the lease, yes, just for analytical purposes and just for the purposes of modeling. The companies may include cash expenses on the lease, and they will show them as an EBITDA item. And in this case, no liability related to lease will be showed as a net debt.
Perfect. Thank you so much. I think we have 2 minutes left. If we have no questions, I will wait for 30 seconds just to make sure everyone who wants to ask something, they have asked their questions. We have question. Would you advise making a CapEx forecast based on reference sources or company forecasts for 5 years on hindsight? Or on hindsight?
So here, the question is quite general. It's very reasonable, but in general, and I will probably analyze, sort of think about this business. Do we have some internal data? Do we have some external? How they are consistent with each other? But I think that this question, that our next, or not the next, but one of our speakers today will be at a better position to comment on this question related to CAPA, I suppose. So I leave this question if there are response to our next speakers.
Thank you so much again. Thank you so much for great presentation, for your insights to the topic. That's quite interesting as well. I would like to thank audience for your active discussion and your thoughts and your questions to Yevhen as well. Thank you. As we have 1 minute before the next session, we will not stop. We will continue with our next speaker. We are a bit continuing with the M&A. We will talk about company value during its growth through M&A. And I would like to introduce you our next speaker, Kulikova, CFA charter holder in the business development and finance profession. Please, I think we could just start. Hello.
Okay. Thank you. Let me share my screen. So you guys can see. Do you see?
Yes, good.
Okay.
But with all the PowerPoint.
Yeah, I can do this. I can do this. It's better?
Yes, great.
All right. Hi, I'm Olesya. I worked over 13 years for American company called Global that developed, acquired, and operated power plant generation assets in 19 countries. And it was owned by a PE fund. They actually Global started, first acquisition was a majority stake in Kramatorsk power plant with a heavy rehabilitation program. So present in Ukraine at some point. My first and only place of work so far. At the beginning of my career, as I started as a junior financial analyst, so figures for the models, both M&A and full development, so organic and organic growth. And without helicopter view of the action, as I continue growing, eventually drafting the investment memorandum, participated in the due diligence, being present in the boardroom for approval of the transaction, then start to have this aha moment of the picture and understanding how it fits into the strategy of the company. And later on, when I continued in corporate finance, it's difficult when you see how the companies that we acquired are becoming integrated business, how the integration works, bringing also like bridges, comparing the value before and post merger. So given my background, I wanted to talk to you today about the peculiarities of the valuation, both for the area and the target, and give examples from the power market, because from the energy market, because this is my domain, let's say. And I think the best specialist, as you also know, in the valuation is the Murina, and he said that just as human beings don't like to teach, companies don't like to get old. All right. So we all the life cycle of a company, which basically says that if you don't grow, you die. And so why grow? To put it simple, is increase their value to the shareholders, and so that they can maximize their value at the exit, whatever option is it IPO or sale to strategic, so to PE fund or any other exit option. And there are two avenues of growth, organic, inorganic, and if it's, for example, for technology companies, if it's a matter of months to create a product and go live with technology product, for mature industries, especially capital-intensive industries like oil and gas, like agriculture, energy, it can take some time to build from scratch. For example, it can take a year just to agree on an MOU with the government, or to run a wind measurement campaign for the wind farms. So not about either or, it's about the combination makes sense to companies' strategy and the vision. Implication for the power plants, basically, when I remember from my experience, more for the greenfield development, they would get a higher internal rate of return than those for the acquisitions, and it's explicable. It's explained by the fact that there is more risk involved in the greenfield or in organic growth than in power plant that is already operating and running and delivering results. Here I also put the divestitures under the inorganic growth. Why it's growth from my perspective is that when a company divests of a non-core, non-performing, non-strategic asset, it releases some extra money that it can reinvest in new acquisition, down the debt, and in other capital projects. Also, partnering aspect, it's important because the company can partner with, for example, financial institution who will have the minority share going forward, and it will access to capital. It will bring additional financial strengths to the organization. For example, you can see an example of NextEra Energy. It's one of the biggest energy utility in US that was IPO'd in 1984 and grew. You can see the share price growth over the past years, grew both organically and through acquisitions. Here I wanted to talk on the bottom right. I put some charts. It's from the Ernst & Young study, who researched 8,000 companies and 23,000 M&A transactions that were involved for the 4 years period, and they found out a really strong correlation between the notion of active buyers in the M&A versus non-buyers. So they heard active buyers deliver both higher total shareholder return and the enterprise value growth for shareholders. And last on the slide, I wanted to talk about globally about M&A market. So of course, you know that in the past it was shaped by the currency fluctuations, inflation, rates skyrocket, global geopolitical risk rise, and this impacted M&A markets. So the global deal value decreased significantly to 2.5 trillion last year. Deals also decreased by 55,000. Mega deals that involve the values of transaction above 6 billion also decreased almost half to 60. I wanted to mention that in M&A market, who is more active? And we could see that it's strategics. We'll talk about them next slide, but it's the strategics. They're accounting for 74% of the acquirers versus private equity, which is accounting for 16%. Here I put also two KPIs which are not M&A, but it impacts M&A market. It's first global IPO proceeds. In 2023, they decreased to 121 billion, and private equity dry powder, which is capital that is committed but not yet invested, is now at a record high of 4 trillion. What does this mean? This guys, it means that there is a pressure in the market on the buyers, on the acquirers, to get deals done. There is a backlog of deals, and we most probably will see the pickup of all activities, M&A, PE, IPO going forward. And this can also put some pressure on the valuations. All right, as next slide. At the very beginning, think at the end, yeah. Because valuation also matters of who's your buyer, who looks at the target, and we can. There are like 4 exit avenues, 4 ways: is the strategics, the financial buyer, PE firm or family office, is going public through IPO or some other conventional instruments, and management buyout. Me working in controllable, we experience, I would say, first 3. I experienced now the management buyout, so I can also speak to what it means and how it's done. Examples of strategic. So who are strategics? Strategic buyers are the company in your industry or in like industry very close that come in to stay long. They want to acquire a company for various reasons, but mostly for synergy, for market exposure, for clients, and also be to kill a competitor, could be to protect from being absorbed by another competitor. So this is how they grow, basically. And different roles. Let's look at this from the perspective, let's say, the owner of the business, because it depends who you ask, which are the cons of the transaction, right? So imagine that you are the of the business and you want to. So what would be the pro for you is that strategic buyers, they're going for long-term. For example, like you said, NextEra Energy, they bought another utility, Texas, and they will keep it for, well, until they divest. If it's strategic, these assets for as it makes sense to them. They don't have this 5-7 years time frame as private equity has. They don't need to divest to cash on. C-level normally exit faster because they will want to avoid duplication of responsibilities and redundancies. Strategic buyers normally as they buy in the same industry, know the industry already, so you need to educate them on what's going on in the industry. It's better opportunities normally employees. It's involving less debt compared to private equity, are very heavily indebted, and higher price. About valuation, I think at the end after we discuss all of them. Then cons or disadvantages: the strategic buyers are sometimes moving too slow. They have advisors normally, but they don't have that sort of discipline as the PE firms will have. Confidentiality is a big one. So imagine that a strategic doesn't want to buy you, but just want to get to know how you operate. So they'll come in, do the diligence, and they say, thank you, but no, but they already revealed all your trading secrets and information that was confidential. Of course, redundancy. So strategic buyers, they are focused on synergies, and synergies come with cost-cutting. So the redundancy is in organizations. Your company will probably its as it will be absorbed by the bigger company, and usually as strategics they buy out so they don't leave equity options for the owner. So if you do want to continue participating in the life of the company, this way is not for you. Financial buy or private equity, you can see top, I think I put top 5 here: SVC, Brookfield, Global Infrastructure Partners, KKR. They basically it's an investment. They're making investment by out the company with the aim to cash out, turn around, and have an arbitrage on the EV EBITDA multiple in a short term, so 7 years. The pros of this, they will move fast because there's discipline. They have already knowledge and the experience in execution. They like to keep management and the owners. This is the first place why they're interested in your company, because you're a visionary owner. You grew up till now, and they would want to continue contribute and stay on this growth spiral. Normally they will keep you. They can also turn around. It's also possible. And sources of capital, because P, as we saw earlier on, the dry powder of $1 trillion, so they have capital to invest. On the cons, you see that the short term, very focused on returns, heavy debt, and can be disruptive for the organization. Going public, and within this category there are several, and there are some examples I put in. Pros, capital, because your shares open to public and to wide range of investors. It's to enhance the visibility of the brand. Although, for example, if you're doing a direct listing, it's already the companies that are more or less visible, and the brand is very recognized. For example, like Spotify or Slack, Asana, they did this direct listing. They avoid the underwriters process, a huge fees, but they were very like certain that they will spike interest from the investors. On the cost side, and I can say that regulatory compliance and report requirements is very heavy. So it's so bureaucratic, and really diminish the speed that you move with, because for M&A transactions, you will need to run different tests and to write reports about them, have a legal team. So it's very, very heavy. Market volatility, and we'll see it later, but prices can be very volatile. It's not necessarily because what company has to offer because of the markets, because of the trends. So something out of your control. So it's because why you have also loss of control and sometimes short-term focus. Management buyout. When I was, I tried to see some transactions with the prices, and it's very confidential. So this is not normally disclosed. There are some examples. You can see. I mean, is that the management team is already operating, managing this, it buys it out from the owners, from the previous shareholders, and it's simple, easy. It can move fast. It's quiet, so it's confidential. You don't divulge the information too much. A little disruption to the workforce. They work under the same management, and could offer solutions. So if you, owner, want to continue to participate into the life of your creation, you can do that. There's possibility to do that. And the con side, it's very difficult to finance it. That's why it's really the management incur very heavy indebtedness, usually with the help of those PMs that also provide that. Management team is not, we're not an owner. They don't have that experience of owning an asset, but rather managing. And started trading in a way that management can deliberately decrease or work towards decreasing profit and earn prior to the transaction in order to decrease the value of the company. And on the valuation side, so I try to put some faces depending on who pays more. And like previous speaker was saying, it depends. Here it's also depends. But research shows that, for example, Financial Times posted an article asking the same price, basically who pays more, strategics or the PE firms. And it appeared there's an analysis that strategics pay more, maybe one time EBITDA, but still matters. But when we to the mega deals, so those involved in valuations, PE firms paid 55 times EV/EBITDA, while strategics up to 77 times EV/EBITDA. So strategics is go-to if you want to maximize the exit value. Going public, it's really all depends very much. I want to mention this one company, Dragonfly, who went public through direct listing, and the initial price was $10 per share. Over the 2-3 years, decreased to way below $1. Owners, of course, initial shareholders, they cashed out well at the beginning, but the investors who bought in this company through direct listing, they lost basically the value of the investment. And management buyout pays the least many funds, but as we noticed that management team don't have too much resources, right? Plus, they usually buy out companies that are distressed or in bankrupt. The price is also pretty low. And they cannot leverage the synergies like strategics or PE firms can, because they don't have a combination of businesses where they can look at the redundancies. So this is the valuation. All right. Yes, I think this slide I want to talk about most, and it's about valuation, price, value. So it's all starts with the into Harvard Business Review, 80% of companies will ultimately fail. That's not promising. So how to make most out of it is everything starts with a strategy. Company vision, where do you want to go, want to grow, and goals and objectives specific 5-year plan out. Then I would talk about the processes, and here it's spoiler. It's about business development team. It proves to be beneficial to have a team in-house rather than using external advice, since this team will normally it's really like this pyramid going like first you have to look at the 20 potential targets, and at the end you maybe buy one. This is true in most processes. Very important to have a playbook and templates, buying from the management, investment processes in place. So all of this, so that you can move faster. Of course, you have plenty of opportunities, and your team is underwater. You would have an advisor who will help you, but they can charge a hefty price for their services, obviously. So on the cash benefit, it's better to have the M&A team in-house. Want to talk briefly target fit. Obviously, it's you need to see if this is the right one for you. How the merged company will look like, market dynamics, if it's in the market that you already operate, what is the growth prospects. And here, very interesting one about the growth prospects is the pipeline. So if you buy in a company has so much 200 megawatts operating plants and 500 megawatt of pipeline, how do you value that? Of course, it's very beneficial to have a platform where you can grow, but still you need to do a due diligence on the pipeline also to see at which stage pipeline is, so that do you have land rights, your permits and licenses, is it 10% finalized, 80% finalized, fully finalized? For example, wind maintenance campaign that is already undergoing, or you will need to do. So as our previous speaker was talking about, this earn-out mechanism, it's very common for the pipeline. Initially, you would pay some premium, depending on how deep the pipeline to the progress. So 20,000, 100,000, etc. per megawatt. And then at some point, if continues developing these assets, you'll get some sort of earn-out at that point. Assumptions is a monster of its own. It encompasses everything from energy prices, prospects to capex expenses. There was a question I will address at the end about the capex. So this is very important. It needs to be refined. Your management should take a clear position, and for example, for the investment doing for the board presentation, all should be justified and have some background why you chose this curve versus plus minus 10%. What led you this reasoning? Model. So basically, the PE investments, they really, are mostly, let's say, valued on the LBO model, since they involve a lot of debt, and it's IRR, which is the main metric of the model. Sometimes, well, it's all of it's DCF kind of based, and PEV sometimes matters when you, for example, look at a transaction and IRR great, but NPV is too low compared to your current enterprise value, and then we will go back to fit. It's probably not the fit for you anymore. Multiples, I will touch upon them a bit later, but multiples to past transactions, we look at them not for identify the value, but rather to grade value. So we come up with some information to see, okay, how's it compared to past 2 years of transactions? What were the solar assets traded on? You can access it. It's either public information or advisors on no name basis. Book value. Frank used very sporadically, but sometimes you value the company and then you see that their net book value is too low compared to the valuation. So there might be something that is deeper in the company business, which you might not understand. So just cross-check how far is it compared to book value. It's also important. Liquidation value. Again, when you start, you look at the end and you try to evaluate all the risks, to measure the risks. So what happens if, for example, the counterparty decides to terminate the power purchase agreement? This is all written in the concession document in the agreement. So what is the value that they're gonna return to you as a shareholder who invested all CapEx in? And it's all also written down. Okay, I think the most important, everything is important. Okay, sorry. Due diligence is paid in negotiation. Impacts the value, obviously, because of the negotiation techniques. Obviously, the buyer wants the lowest price, the seller the highest. So where do we meet where's that break even both counterparties? Characteristics. There's research that showing that cash deals versus share deals. The deals are doing better over long term. ESG regulations. Want to buy a company that will impose you reputational risk. For example, if you do your due diligence and you figure out that there are some implications with the developers of the project, and if it's difficult to mitigate that risk, maybe it's a no-go for you. So recently, regulations, especially monopoly, became more stringent. So you need to consider those when you acquire big targets. Merger integration. I think it's a separate topic and very important. And people saying that research also, Estonian, PwC, all big consultants saying that most of the value erosion comes from very poor integration. Most important value creation driver. Goldman Sachs did the review, and they know that the general they're adamant in adding value to the portfolio companies, to the acquisitions. They do it through different avenues, different ways, and they say that over the past 20 years, they were able to deliver 50% IRR, which is great return achievements, and they're doing it through 3 types of the value level, which is operational problem, for example, a big one, and it can be up to 50% of the IRR, or should be actually, I would say. And this is the same synergies talked about a little bit. So cost cutting, cutting out waste, cutting redundancy in workforce, in business units. So optimizing that structure, revenue growth, organic and non-organic. That's also operational efficiency and improvement. It's an important category. It can encompass everything, and if you're a great operator, you have with experience, you can really add value to the businesses that are not even neglected, of course, but also that are just operating average. You can, for example, think about insourcing versus outsourcing. You can think about unmanned operations. if you have a power plant with additional few hectares of land, or I say a parking lot, you can build additional solar panels on top. All these comes as a very sophisticated operational improvements. Industry know and benchmarking. So you would hire some technology experts that will come in, examine your business, especially if it's a new one. For example, if you're at a CSP or offshore wind, you don't have this expertise in house. So first one you do is that you will benchmark your asset against what is going on in the industry and what are ways to improve it. Deal structuring. So basically, in past years, up until the crisis in the borrowing market, structuring played a big role. When we were in models, creating models, we were always looking in what is the core operational, let's say, IRR versus the financial IRR. It's important to separate, because when you see 5% of IRR coming from the financing or deal structuring, then it's it can point you to think twice and just rediscover again the assumptions you put inside. But Blackshield, the ownership, and the ownership, I wanted to talk about downs as a very interesting tool to bring value for companies like, for example, Ørsted, which is one of the biggest also renewable company in Europe and the world, using farm downs. What does it mean? They build a power plant, and at some point they decrease their ownership to, let's say, 50, and it depends, by selling the other part to a partner. By doing so, they are kind of playing multiple expansion. It's arbitrage, right? Because people in when it's already operating, already without construction, so the multiples, basically return requirements be lower, meaning that they can pay higher prices, and you continue to operate the plant, you continue to manage it, and you an extra fee for as an operator. So it's a very interesting instrument. Like Ørsted recently farmed down the offshore wind in Thailand to be expansion and arbitrage. That's another way to. But basically, this is the core of PE firms. This is what they do. They buy when the market is, for example, when the market is not so great, EV/EBITDA multiples are the cycle reverse, multiples are it, and they sell it. So this is how they would make money. Sorry, just wait. So failures, sorry, failures rate is the main source of value error. That's what main financial advisors, the consultants agree on, that it's not being able to integrate on time, because time is value, and to the extent needed, basically wipes out your value. So there are several, I mean, hard, soft, tangible. So when the target doesn't fit, and then you're left with an asset that needs turnaround, or you don't have internal abilities, there are multiple reasons for that. Overpayment is exactly because of the cycle, for example. If you bet on the hype and then the cycle goes down, then you could have bought the same company much less. Miss the due diligence, which is discovered later post-merger, and you are not covered for that in the SPA, warranty section, etc. Model mistakes, which I guess everyone who did modeling encountered this. Can be big, small. One of the biggest, and I learned about Lazard, who advising the solar city on the scale to Tesla because of double counting on some indebtedness. They discounted the value by 400 millions. So, it still was in the range of the deal, but not very nice, not very nice mistake to do, and wrong assumption. So basically, you should, based on commercial reports or on something, the price, electricity price will grow 3% or 5% over the next 5 years. And in fact, you come in and the market is different and it's stagnant and there's no growth at all. So this can have a huge impact on the valuation. Then integration, let's say integration issues or post-merger that appears, the culture crash, the talent loss, the employees, they don't work under the new management and they leave, or they became engaged in a way. Very important is the communication, and it should be constant, and lack of proves to be disadvantages. Post-merger, if you don't have a proper plan, also impact your valuation discussed. So you might have overstated the synergies and not able to obtain them, etc. So 2 cents on these, like if we talk about techniques that could help, and then I personally worked very well, is that we cannot underestimate the value of failure, analysis. The former CEO of CounterGlobal, Joseph Brand, he really focused a lot on this, on continuous improvement, failure analysis. This is a huge, like documenting your lessons learned. When you will, it's applicable not only in M&A, irrespective of which company, which department you are, together with the team and discuss without naming, but just dig into the schematic errors in the processes that you have, on improvements that can be done in order to avoid all these mistakes that happened, right? Lessons learned analysis, post-mortem you can do for each transaction. You can do 5 whys for material mistakes or near misses. All of that you can Google, dig deeper. But I feel it helps you to preserve the institutional knowledge, so not the individual, right? It's great if you have someone who's working all your life, 30, 40 years in one company, but without writing it down and documenting, although it has time, without doing so, you cannot guarantee that this knowledge will sit within your organization and will benefit you the next transactions come across, help you speed up in the next transactions. So creating playbooks for processes, especially for big ones, due diligence, for integration, for more, all of that should be documented, and it's taken basically practices from this failure analysis and putting together in a book. Can be quite heavy book, I would say, but it helps your teams do better next times. Also, powerful tools are objective setting, KIs, OKRs, rails, or whatever. Setting clear, smart ones. There should be a value to it, or yes, no, etc. And by specific time, and this helps manage the process. Especially, it's very important for, I would say, for integration, because there is an integration plan. You say by 100 days, a new of all operational panel should occur. By 360 days, this and this should happen. So it's very clean and clear way, and putting everyone on the same. And then all this random, not words they put together, the cross-check, benchmark. Benchmarking is a very powerful tool. Actually, you can easily do it with inside information, or asking consultants and advisors. Challenge brainstorm. So we actually had this cool technique of having a challenge team. So when transaction is point into the M&A, you would assemble it that examines the transaction, the model, the investment memorandum, etc., the presentations, due diligence materials. We'll come up with a really question that the M&A team need to address in a meeting. The risk assessments, testing, etc. One more point. I remember having buy-in. I didn't put it here, but buy-in from internal team, having that participate into the due diligence. I mean, not the M&A team, not business development team, but the team that will actually eventually run the methods. So, operations team, HR, finance, etc., having participate early on in the due diligence, into the modeling, into the discussion of investment, will really bring value into this exercise. This proved to be true for this. Okay. I think that's probably one of the topics I have. Sorry, I was a bit. So evaluation adjustments, DD findings. So I think that know this bridge. We bridged either IRR or EBITDA or earnings per share or enterprise value. It depends. At least in two instances. So first, post DD findings, right? When you are into coming out from the due diligence process and you have all these reports handy, you start to look into what it all means for the valuation, right? I offered the non-binding offer or binding continued offer, whatever, offer this amount. So all these findings, what does it mean? And this is just an example of, not to any transaction of magically the value post valuation, post due diligence. But all this is important to and some findings they will go into the purchase price, and some they will go into IRR. You will share those. About merger, the synergies. Also wanted to mention that according to the research, the synergies that you as a buyer like to implement, they say that 50-50 you share with the seller, meaning that 50% improves your or whatever metric you're towards the valuation, and 50% will increase the price for the seller. And to be more specific, right, since it's a power plant business, this is the list of due diligence activities that when you purchase a power plant, you would want to look at. I don't think that everything should be external or outsourced. Great if you have capability and knowledge to do it in-house, and some you would if you grow fast and you are a big acquirer. But these are some that help you gauge if the value was right or not, and also to risk assess, because it's not only about right, but if there is a risk, your risk appetite cannot absorb, that it's potentially a no. Very important to do visits. Underestimate its importance. You get to learn the business, to know the business, to see it, and normally evaluation is much more cleaner. Plus, helps you also work on the merger integration plan and make it really applicable and worthy, not just putting your finger out. I think we might have one more probably slide about, yeah, this one. I know like charts, so I put some for you here. Observations, not mine. I don't have that database available to me. Top right, transaction in public buyers enjoy higher multiple. So that's why it's not a goal per se, but if you want to maximize the value of the company, going public at some point will make you more attractive and valuation better. Why? Because it's less for the buyer. If you are public, it means that you need to confirm with all these regulations and stuff. You are open, you are transparent, your financials out there. You are you have research analysts who cover your industry and have potentially you have a credit rating reports, etc. So there are different sources of information that can help investors with the valuation and with assessment. Then probably, okay, let's talk about left side. It's all about multiples, and we see that the market is not so favorable recently in terms of EV EBITDA multiples. But this is energy and power in general. On the slide, the bars, they show the renewables assets, and they still trade at premiums, not crazy premiums like in December 20, but still at the premiums. So it's beneficial change your strategy. What it tells, right, as a company that if you own coal or oil fired assets and you want to have valuation, it's probably time to decarbonize. Then time and cycle matters. That's talking about the arbitrage, really crazy, crazy multiple for renewable products and services. This is not the general, right? But it's like producers, inverters, or producers of solar panels, etc. It also depends which is the cycle you bought the company. And the last one, right bottom. Here's just I wanted to put EV/EBITDA because when we talked about past transactions and multiples for energy sector, it's really EV/EBITDA that matters most. See that companies there is a wide range of multiples, and it depends on the model. If they're fully renewable, if they're merchant, which means that your stream is not protected versus PPA or feed-in tariffs. If you are OX2 is a developer, so their model is they develop solar and wind farms, and they don't own them; they sell further. So this seems to be beneficial if we look at the beneficial model compared to others. All right, I think that's all I have because we are out of time.
That's okay. Thank you so much, Olesya. Give a great presentation. As usual, we have like several seconds for you to put your the chat or just raise a hand. I haven't asked it for Yevhen, but probably will to ask it for you because
yes, I see this one.
No.
It's a great one. From my experience, right? So would you advise making a focus based on reference sources or company focus for 5 years or on hindsight? Depends. You it depends. Companies operating already or not. So or it's just out of options. So probably normally it would not require huge capex over the next 2, 3, 5 years. Then there is a cycles, wind for solar, etc. When they need to sorry, I'm talking about energy industry, so power plants, where they need to all the minor or major maintenance. Thermal assets, it's much complex because you have different part equipment, it's boilers, steam turbines, etc., engines, and normally you have warranty from the producer, right? So you buy Vestas, you buy from GE, other companies, and they provide you a warranty. And normally, in some cases, but this also comes to operation improvements in sourcing versus outsourcing, right? You can outsource your maintenance totally to these providers, because they're not only manufacturers, they also provide an operation maintenance services. And then you have a contract for the next, I don't know, 10 years, and you basically know these figures. Yeah, it depends. So it depends. If it's some industry that doesn't require heavy refurbishments, then it's perfectly fine to look at the retrospective, continue, right?
Maybe from my question is about the ESG, because you have a huge expertise on the foreign markets. What is the influence of ESG factors to this valuation within the M&A, and probably the best way to incorporate these ESG factors into the models, if it's possible?
Yes. So look, how we were doing, right? We had a very high, the company had a very high standards of health and safety, for example. That's for energy generation. That's number one that you should focus on, and all your playbooks that we included then into integration plan, and it's capex, right? It's capex or opex depending on amounts, but you do the due diligence, and then this company basically make up for the health and safety because it's not up to our standards, and then we will put the capex into the model, so it's a cash out, but we cannot not do it. Then it's social responsibility. So you will see these companies energy ads. Since they impact the environment where they operate, they have this so-called grievance mechanism, so the community can get together and vote to impose something on you, etc., etc. So you would also, as a good data, you would want your communities to be on your side. You would do social it's not charity, but social programs. You would help, and you see people, companies usually boast of their results in the airports, but we did in Africa, especially building marketplaces, building refurbishing the schools, but it's not because okay, there's some ESG imperative now in the but because because it's in the vision, right, of the company to make the we operate better. This is what the value of the company was. So this is how we see. But it's interesting about the G now, about selling off assets. So basically, you can see the gap in valuation of companies that have in their portfolios coal or oil-fired plants versus those who are fully renewable, at least renewable plus gas, and it's a big discount. So you might think of that too. It can be a cash generating machine, right? Depends on the investor.
Thank you so much.
I hope you answered.
Yeah, sure. Thank you. I think we have no question for now. I would like to thank you, Ali, for a great presentation. Your insight into the topic as well. And I think now is a great time to have a 5-minute break just to refresh, because we'll have another session in 5 minutes. So please, we're waiting for everyone just in 5 minutes. Thank you for staying with us. My apologies. I'm trying to discuss with everyone on mute. My apologies. We're continuing our session for the probably last but one of the most exciting topics for today. Thank you so much for those who just mentioned me that I'm on mute. We will talk about the estimating capex for terminal value on some theoretical and practical considerations. I'm very pleased and happy to introduce you our speaker, Hanna Murina, CFA charter holder and the short-term consultant of the World Bank. So please, Anna, this virtual stage is yours.
Yeah. Hello, everyone. Let me share my screen. I hope everyone can see it. Yes, great. Yes, at first, a short disclaimer, my employment engagement with the World Bank doesn't have anything with this presentation, and its content is pure my responsibility. And this is actually the result of 20 years work and thoughts about business valuation. When I started my work in a PhD program, I returned to the question which came to my mind almost 20 years ago. And I also was supported with two great persons in researching this issue. This is Gilbert Matthew, who formulated the problem of estimating capex for terminal value and asked in his articles this question. And also Peter Jenegren. This professor also had a brilliant article. I made a step forward after his conclusions, but his article was great, and unfortunately it was not appreciated by the community. And but his finding was very important for my work. What is it about? I guess everyone in business valuation already saw the rule of thumb that for terminal value, we need to estimate sustainable cash flow, and sustainable cash flow has a component CAPEX. And this CAPEX sustainable cash flow should be equal somewhere about depreciation charge. And this rule of thumb is present widely in corporate finance textbooks, in many valuation methods, and even in valuations, international valuation standards. At least Tegova has such provision in the standards. But the life is changing, and for example, based on surveys of US valuers, business valuers, they agreed with this rule that capex, sustainable capex is equal to depreciation charge. They believed in it. About when they did the survey in 2011, you see the majority of the evaluators, professional evaluators, they agreed with this. But by 2017, the majority said, no, the rule is not good. Capex must be somewhere above the depreciation charge. But nobody can explain why or how much in cases. So there is uncertainty, and in some cases, in some valuation models, this uncertainty can be very material for industries, for some long-lived, which have lived assets. This uncertainty can be very material for the total valuation result. Consider we are talking about not multiple valuation, but we are talking about discounted cash flow valuation. And we are talking about terminal value, which in my case is determined by Gordon Grove formula. Besides, his name is Miron. He is not from Ukraine, but his parents are from Ukraine. He was shortly after his parents came to the US and was born by these two Ukrainian persons from Odessa region. On this exciting working on my topic. So we are trying in this presentation to understand how these red letters are determined, how to estimate capex for sustainable cash flow, which is used in terminal value. Another important feature that terminal value in many valuation models is the major part of the total value. So this is very material for many cases. In my work in investment business, I used the manuals which was provided to me. I used textbooks with rule of thumb and modeling, and I did robustness checks. And my conclusion about 20 years was that the rule should not be right, but why and what can replace the rule I found just very recently. Why it is why the problem? The sustainable cash flow is something that is recurring from year to year of a similar amount, and for operating part, operating cash flow, it is recurring. It has recurring nature. In financial analysis, we trying to find all non-recurring one-off items and clean the operating cash flow from these one-offs. But CapEx, by its nature, is not very recurring on every year the same. In many business, CapEx is a result of long-term decisions on business, what assets they need for many years ahead to produce the profit and the growth promise. That's why I dislike the rules, and mathematical models, robustness checks also supported my opinion that the rule cannot be right. But it was popular, and it was difficult for me to object the rule at very early year, but now I guess I have more knowledge and strength, and also support from academia and practitioners, and from the two I showed before, that the question was our attention, and some better answer should be developed to replace the rule of thumb, which is misleading. Why the rule of thumb is very popular? Because it is simple. It is we take the depreciation charge which we must forecast and put this figure to CapEx. It's very simple. It is difficult to find a better alternative. That's why for many years the stayed in many sources, standards, and textbooks. Right now, as I showed the way and some research papers, the rule is questioned heavily, and there are huge doubts about this. It's correct. A rule can be wrong. First of all, and the most easy reason to blame is inflation impact. Inflation is, in most cases, is increasing the price of the fixed assets, and depreciation charge based on historical prices can be sufficient to replace the same assets at increased prices. But also, in addition to inflation, many models, they assume a real growth in output. And this growth in output will be supported by growth in capacity. Capacity is based on fixed assets, so more fixed assets are required to support the growth. But also, there are some other reasons why we should doubt, like non-divisible fixed assets, which create irregularities. And when there are irregularities, then time value comes, and we need to account for time value by discounting. But also there is the direction of the technological progress, which may decrease the CapEx if there is less need for CapEx per unit of output. Technological progress may decrease CapEx in future. There are a combination of reasons without the rule. Let's consider how this reason work in an example of 5-year asset, and how it is bought in zero year, how it is depreciated from 1/5 year, and how it is replaced at the end of its useful life. At first, when we plan the cap at the end of useful life of the assets, we take the depreciation charge at historical price. This is the dark green. Sorry for. Then we have to add real growth, the demand for increased capacity for the future useful life. Then we need to increase expenditures on fixed assets because of inflation, and possibly technological progress increase the capex need in the future. So these components are shown here just to illustrate what are factors for, what is against the increased access on fixed assets. And if we have fixed assets and all they are similar and they are replaced year by year, then likely adding all together, we may regular capex and regular replacement of fixed assets. And many companies have this position, then annually they spend on fixed assets similar amount. But even in this case, if we model equal replacement gradual year by year, capex is not equal to depreciation. It's still higher than depreciation because of inflation, because of real growth. It cannot be the same. So the rule of thumb is not working even in the case when placement is smooth on every year base, when everything is flexible in the fixed asset. It still does. It cannot. The rule does not hold. In this case, the capex, it's still high depreciation charge. This case, they may how to identify or confirm such cases. The average depreciation level or average useful life of such businesses is every year about 50%, about half of useful life on average in each year. So these are cases of businesses with smooth regular capex. In this case, as we shown before, a capex is a depreciation charge, but in most cases, but how much it depends on the growth rates, inflation, and technological progress. And possibly the rule of thumb may be true, but only under condition with the total result of growth rates, inflation, productivity, and real growth total is zero. Then the rule of thumb may work. It is not realistic. It never happens. Even more rare case when capex is below depreciation charge, when the total growth rate is negative. But most cases when the total is above zero and capex should be above depreciation, bigger than depreciation charge. And in such cases, we approximate capex in each year from the capex of previous year, adding annual inflation, annual real growth, annual technological progress. In terminal value, after the forecast period, we should not take technological progress. That's in terminal value after the forecast period. It should be conservatively assumed zero. The inflation and real growth are the factors used in capex estimation for sustainable cash flow in case of regular capex. So the main drivers are inflation and real growth rate with regular. When we determine is it regular or irregular capex, what is driven, what drives capex future, we look in the past. We may see only regular capex, but it also may be true in all cases. If in the past we see only regular capex, but we still not see some very old capex which is regular. In my illustration, I used capex of 35 years, and it may not be in the periods. You may not see the cash flow, huge cash flow for this irregular capex, but it is likely to repeat in some time in the future. So looking at historical capex and hoping that it is regular in the past and it stays regular in the future may not work if business has any kind of long-lived assets. Long-lived assets aren't likely to be regular. They are repeated with long periods. They are likely difficult cases of irregular capex which needs additional attention. So in this case, if you do not take into account this irregular capex, which has once in 25 years, we may underestimate capex need for a huge amount and overestimate the business value. So historical trends for capex are important. They can tell much, but still need to review the capex, the total list of capex items or fixed asset items, and to be very careful to items which have long useful lives. The case where I'm trying to show why time value of money comes to capex estimation. Because in DCF model, we take the reported period, then the forecast, we have for horizon, and value describes everything beyond forecast in the future. And if we compare just cases when forecast period starts and the beyond this period post forecast, and after 7th year after the forecast period, there is a huge capex, irregular capex. Relative to another case, then regular capex is happening on 7th year, but on 3rd year after the horizon period, which capex, how this difference in capex after horizon period differs the result of the valuation. If we must take time value of money into account by discounting, and when this irregular capex happens very close after the horizon period, it is very soon, and it is little discounted, decreases the total value much more than the huge irregular capex which happens on 7th year on for horizon. This is just reason why time is important and what we take into account timing of irregular capex. So again, irregular capex, what happens sooner after first horizon has higher impact on total value negative. It decreases the value. The irregular capex which is happening later. I proposed a formula which takes into account all the factors we just discussed, and I tried to illustrate the real growth, support capacity requirement, the inflation factor, and the discount rate. And the formula, derivation of this formula is very similar to Gordon-Grove formula for terminal value and based on metric series. Let's show how I came to the formula. I took irregular capex, that derived the sum of all the items, all the cash flows. Then I took a case of simpler, easier case of regular capex, also found the sum of all the cash flows, made them equal, and derived the property regular capex, which is equivalent of irregular capex, and which takes into account all the factors, all the values used in the cash flow model. By this way, we can model how the rule of thumb is wrong. On this chart, there are five cases when the rule of thumb may be right, when there is no inflation, no real growth, and almost zero discount rate. Then the rule of thumb, which is in textbooks, in the manual, the valuation standards may be. But in real life cases, when we have, first, let's take discount rate. If our capex is irregular and it happens sometime sooner or later, this irregularity makes difference. For cases when capex happens later, and the fixed assets used in business are relative few. So useful life portion is low, 10% and 20%. Then the ratio capex to depreciation charge may be even less than 1. For new businesses, the rule of thumb generates take which underestimates value of new businesses. And when the business has very old assets, where useful life is high, 70, 80, 90%, the ratio, which means capex need is somewhere close. In these cases, the ratio is much above the 1, much above the rule of thumb. Other variable, inflation and real growth, they shift the curve up, down. So the discount rate determines the slope, and the inflation and real growth, they may shift the curve up and down. This chart shows how the rule can be wrong, depending on the level of useful life and other parameters of our valuation. And again, in this example, we analyze a fixed assets of 10 years useful life. For some other years, the chart may have other parameters. If we take 7 years, 5 years, so for each number of useful life, there is different chart. This is particularly developed for years useful life. It's exactly what I described. Slope is determined by discount, and the inflation and growth rate, they shift up. Let's see. Return to the formula to take into account that this formula is developed for each fixed assets, for individual fixed assets, for each item. And in real life, in practice, we do not value each fixed asset separately. We try to do it all together, or at least in groups. And from theoretical derivation and mathematical correctness, there was a need to step to the practice. And how to come to the practice when there are too many fixed assets to apply the formula, even if it is mathematically correct, to each fixed asset is not realistic. So we may group fixed assets for the parameters which have index xx. So the parameters for grouping fixed assets are important. These are the total useful life, and the second is the portion of useful life. Portion of useful life, this is the ratio of useful life to total useful life. How old or young are the assets? So by grouping all the assets by these parameters, we may apply this formula to the groups. Another alternative how to come from the theory to practice is doing separated fixed assets on regular capex part, which happens every year, and possibly try to identify fixed assets with long-lived useful life, and these big items model separately and add regular capex, then plus irregular capex, which is estimated by this formula individually by several groups for big items. Again, here we come to the practice, which turns difficult because we have many businesses have too many assets. Grouping still is difficult, and for group, we do not have sufficient information if we are investors, not insiders, not managers, not owners of the business, because owners, the managers, they have everything. They can group perfectly all the assets and apply and estimate correctly the sustainable capex. But investors cannot, because they do not have the same access. There is information asymmetry. Usually, what I was able in practice, I was able to derive the total useful life. So I could group or estimate, see what is the average useful life for main groups of the assets. It is much difficult to understand how old or how many old assets and how many new assets and what is the combination between old and new assets to apply this rule. IFRS disclosures, the notes, they usually do not say anything. They do not provide detail on distribution of the useful life or depreciation or explanation how many old and new assets are in the business. That's why is difficulty in applying mathematically correct formula and trying to replace the simple rule with this formula, because there is not sufficient information for this. And I try to estimate what possible mistake can be if we apply the rule to the of assets. In this slide, we group assets by total useful life. The first table, let's consider the table. The homogeneous groups. The assets are of 6 years useful life. The alternative picture is that the group is homogeneous. The useful life varies from 4 to 8 years. This is the first, the life. But then there is variation in the used life, the used portion, second line in the table. All assets could be at half of depreciation or half of useful. They may have dispersed used useful life. They may be very old and they may be very new. So it's 4 possibilities. And in trying to estimate what is the mistake, if we use this formula, the derived formula for the groups of assets, to compare with the rule of thumb or compare with the true value, which can be estimated by an insider with full access to information. And we see that for the groups with usual useful life 6 years or about 6 years from 4 to 8, the error is not big. If we use the average for the assets, for the useful life and for the portion of useful life, the error will be, but it is not big. It's about up to 1% for this useful life, about 6 years, which is not big. And if we look at the rule of thumb creates huge mistake, bigger mistake, even if compared to the true value. This is the estimation how can estimate average for the groups from the financial statements, and it is possible, it is tested many times. Again, we may apply the formula for average parameters of grouped assets. But situation gets worse when the useful life increases. And if we take groups of assets, not 6 years, but 18 years, or heterogeneous group of assets from 16 to 20 years, then mistake is increasing, and apply formula derived for normalization for sustainable capex to this case, then the error becomes greater by 5.5% for the most difficult case of dispersed useful life. In the derived formula gives much better result than the rule of thumb. Rule of thumb for long-lived assets may be hugely misleading. again, I repeat, the main difficulty in application theoretically sound formula for estimated sustainable capex is in inability access to have information about useful life. How many assets of business are old and will need replacement very soon, and how many assets are new and will need replacement long time in the future. This information currently is not available in the IFRS disclosures, in the notes to financial statements, and this is the main source of error in this estimation, which I present these slides. What may be improved when I did this presentation and explained the approach on the recent conference of European Association of Valuators and Analysts, I suggested that financial disclosures should be improved on fixed assets to give more information to value business better. And currently, what we have in disclosure is often that you may find that all fixed assets are grouped already in financial statements in the notes. You may derive depreciation level if there is straight line depreciation, or you may find other indicators of useful life average for the group. And usually we are given the value, the cost, the historical value of the assets. What would be good to have in addition to this disclosure, which we currently have in statements, the distribution of assets by groups of new, relatively new, mid, some half depreciated and very old assets. So at least 3-4 groups. If we have this distribution, then the mistake or error in estimation of normalized capex gets from 5% to almost 0%. But so this disclosure is not available, and exact mathematical and logical correct estimation is only accessible to insiders of the business. This information asymmetry exists, and possibly I expect it will not be resolved in close future. So we are given the ability to use rule of thumb, which generates huge errors, and there is possibility to use this normalization formula for at least items and have more precise estimation for sustainable capex. And to finish the presentation, let's consider a practical case. I took this example of valuation from internet. This it has very respectful valuation firm behind estimation, and just look at the numbers. First, capex is material. Usually in valuation models, we so much attention on operational part, operating capex, and so little is given for capex. But it is material. Sometimes it's 2/3 of the total free cash flow. Some it can be 1/3. It is material, and it should take our attention more in how firm we are in this estimation. In this case, in this company, see that capex is relatively huge in recent periods, forecasted periods, and actually I looked at the recent reported periods of this company. It was also huge. It was big about this, and it is times higher than depreciation charge. This should somehow hint us that the rule is not holding in real life, but the model assumes that person comes to the rule of thumb and capex is going to be equal to depreciation charge very soon in the future, and it remains so in the perpetuity. Very likely, it is not the case in real life. This company has assets of long lived. useful long-lived assets, and they were replaced actually in 2016, 2017. They were forecasted to be replaced, and this replacement must happen sometime in the future. And the capex, sustainable capex forecasted at depreciation charge amount is not taken into account the capex need in the future. That's why this model is underestimating capex and overestimating the business value. Very likely, this business, as many other, they have recurring capex, which is every year, for the which have short lives, 5 to 10 years possibly, and businesses this use 5-10 years, they have smooth replacement pattern. But also this business clearly has irregular part, which can be estimated by a normalization formula and must add it to regular part, and sustainable capex for terminal value is higher than here estimated at the depreciation charge level. So this valuation model is illustration how it is misleading and how in this case it is overestimating business value. I guess I finished and I more time for questions.
Thank you so much. We have the first question from chat, so I will start with this, and then colleagues, don't forget you're using the chat or raise a hand tool to address your questions. So we have a question from Mikola who asked the following. We discount future capex, correct? How do you propose to forecast for first projected period, then post period terminal value? Should this data be from the balance sheet, company forecast, or external sources? Yes, external sources.
Possibly, let's. I will tell from my experience and what how I perceive valuation. Valuation has a purpose for whom, who needs this valuation, and possibly if strategic interest, strategic investor, it has a plan for the company, and this plan should have behind the capex need. If there is the order for the valuation model is the owner, and you are inside the company and ask valuation for the owner, also there is a plan behind, and the capex must support business needs, business growth for this plan. If we are minority investors and we do equity research for minority investors, we cannot drive the plan. It is somewhere. It exists within the managers and within the owner, current owner, and possibly the best source for capex for information is the reporting, financial statements, business plans, and information on future from the managers and the owner. Each valuation has a target interest. Who is ordering the valuation? And in each case, there is a specific answer. I hope I found. In case of most cases for equity valuation for minority investors, we need to listen to manage the current shareholder and follow their plans, because we do not have power to enforce other plans. So the valuation will be driven by the plans of the manager, and we need to be careful to the financial statements. That's why transparency and detail in financial statements in the notes are critical in this case. I answered, or please develop the question more.
Like 5 seconds, maybe. Managers' plans described by mathematical formulas?
Sorry,
We have the extension to the question. Like, are managers' plans described by mathematical formulas?
From managers, we need to know the growth rate, the real growth rate from the managers. What is the growth they assume, and sales and behind to support the sales growth from the management, we need to what capacity we need for the sale. Then we need macro forecast to have inflation, and capex we heavily will depend on inflation forecast and growth forecast. Real growth is taken from managers.
Okay. I hope. I'm just waiting if Mikola
Yes,
if
while
not,
we have time and about science, math, and valuation, there is very popular statement that valuation is not science, it is art. And I like to object this statement and say, no, it is not art, it must be craft.
it's only art.
It must be craft. It must be craft.
Okay. Mikola writing on the chat, my point is that capex review is unpredictable in a sense.
It is certain, but still it's very big part of the cash flow. We cannot say that we cannot, we should not, or we are not capable to estimate it, or why we cannot do valuation. We shouldn't be able to do valuation. If we try to do valuation and fundamental analysis, not the multiple analysis, fundamental analysis of the plans for the future, for the years ahead, then we need to understand the real growth, so the inflation, and take this into account for sustainable capex in terminal value calculation.
Yes, and usually capex is huge amount. So
yes, exactly. On the conference in Europe in Berlin the last autumn, I heard from many participants that this area is underestimated in our. We need to pay more attention to capex because it is material, and we analyze little for capex in DCF at least. And another opinion was a huge interest from the US because already the practitioners, they acknowledge that capex cannot be equal to depreciation, and they are trying to define the rules how to do better than the rule of thumb. Actually, there was huge interest from the participants that take part in court cases about share valuation, share price valuation. So this question has interest, huge interest.
And Mikola noticed that the manager usually make forecasts for 1 to 2 years at most.
Okay, but our valuation model is doing forecast further.
Yeah. We have a question from Murina. If depreciation is straightforward, what to do?
Straightforward, you mean not
Mhm.
straight line?
Probably.
Straight line.
I believe yes.
Yes, if depreciation method is not a line, then actually from the first article to the presentation, I'm trying to replace the technology, not depreciation level, but useful life, the portion of useful life. We need attention not to it is not straight line depreciation. We need more attention to useful life, total useful life, and the ratio between them. That's why it is preferred in the financial statements when companies tell what is the useful life, the remaining useful life, what is the total useful life. In such cases, it becomes critical.
Thank you. Very probably a very straightforward question on this. Any you could feel for now during your researches on that. Any restrictions on the model of the normalized capex that, for example, it's not working for any kind of industry, some kind of industry, or for example, some side of the companies, or for example, if any other restrictions that could be, I don't know, unexpected huge growth of the capex in several periods or something when it's not working.
I heard from colleagues from the US that service sector, services, everything, services trade, which does not need long-lived assets. It goes very well with the rule of thumb because the assets are short-lived and small portion in total cash flow. In all other cases, the deep thought is needed. But for huge companies, multinational companies, as bigger company, as more enterprises and as more production outlets they have, as more units they have, more flexible they are. Then, if they are huge and they may plan CapEx annually and from one production site to another, possibly their CapEx pattern is regular, and the inflation and real growth on annual basis can be taken into without much complexity, without this huge formula irregular part. In every case, when business is not huge, no 1,000 production sites, there is only one production site. You will need to replace the equipment once in 30 years. You need to take into account in the cash flows that in 10 years after horizon period, you must need this huge capex.
Yes, correct. Yeah, okay.
So for big businesses, this less critical. Smaller businesses, it's critical. And particularly for heavy industries, small one production site industries, it gets critical with long-lived assets, particularly.
Yes, that's yeah, that does make sense. Yeah. Okay, I will wait probably from the audience wait for questions if we have more questions on that. Okay. Just a minute. Please, if any questions, please, you could just make it simply, just raise a hand or just write on. Wait a bit. Okay. I believe I see no more questions. So I need to thank you so much, Hanna, first of all, for the deep this research you're doing on this topic, and we hope we'll wish best of luck with this work that you are doing. Thank you so much for great presentation, for sharing all the insights with us today. My deep thanks to our audience who stayed with us the whole day today for the different topics with different knowledge and expertise. Thank you so much as well. And I think this is to wrap up. I thank all the participants in the event for your active participation joining us today. Thank you so much for joining us, and I hope to see you on our next events and initiative. Thank you so much once again, and I wish you the safe and rest of the day. Thank you.